classes every 2 weeks with them. If you would like to catch up on our previous episodes, please go to the iFi Global podcast library, which can be accessed through the iFi Global website. Today, we are going to hear from Simon Osborn, the CEO of iFi Global, Lawin Chandra, the CEO of aiRaiz, and Miguel Sanchis, an associate at aiRaiz. Simon is going to give a brief macro overview of particular relevance to private market strategies. aiRaiz is going to cover recent developments in LP allocations to private asset classes. We will then finish with an open Q&A. If you have any questions, please do use the Q&A button at the bottom of your screen. And I will hand you over to Simon.
Thank you very much, Samantha, and welcome everyone. We are pleased to see that, as ever, we have a lot of people from different countries joining us today. My name is Simon Osborn. I am the CEO of iFi Global, which is a research and media house based in the City of London. We have 3 monthlies, and we also have a macro weekly, which, given the global circumstances that we will be touching upon today, is becoming more and more relevant. One of those monthlies is Alternative Investment Strategies, which we are now doing as a joint venture with aiRaiz. And a lot of the subjects that you are going to be hearing today, you will hear are covered in detail in that particular publication. As Samantha says, we are doing these podcasts and webcasts every 2 weeks, once in this particular format, and then alternatively, the other one each month is delving into one of the particular private asset strategies in considerable detail. The next one of these is going to be in 2 weeks' time on venture capital. And if you want to pick up the one we did on private credit, which was just 2 weeks ago, as Samantha says, you can go to our library on our website and find it there. So as Samantha says, I'm joined today by Lawin Chandra, CEO of aiRaiz, and Miguel Sanchis, who's a financial analyst there as well. Right, if we can switch over to the next slide, Samantha. I'm just going to talk very briefly before we hand over to my colleagues at aiRaiz about some 2 broad brush global macro developments. One is the politicization, which isn't really a word, but I think it's going to become a word, of markets, which is going on at quite intense speed at the moment. And this is new. It really is new. I think I've been around, unfortunately for me, for a very long time. I've never seen the markets react to political events as they are doing now before. Of course, occasionally you get, Saddam Hussein invading Kuwait or whatever it may be. It's a brief thing that goes on for a short period of time, and everyone forgets about it and gets back to what they should be doing, which is focusing upon market-based activities. What we are seeing today, we have never seen in our lifetimes before, which is markets being driven by political events. Now, this may be, let's hope in a way it is, very temporary, and we'll get back to the more benign political environment that we are all used to in the foreseeable future. But one of the things I found fascinating in particularly last month or 6 weeks, or even the last couple of weeks since the markets crashed, the public markets, I should say, is that the analysis, we get a coverage of a lot of analysis put out by the investment houses in terms of what's going on. I thought what their coverage is of the recent events, I thought it was really astonishingly, surprisingly poor, because these people don't have any kind of a geopolitical background. They're excellent technicians. They're very good at crunching the numbers and all of that good stuff. And they can explain and slice and dice anything in every single which way in terms of the value of the securities they're looking at. And it's all very impressive. But when you take them into a wider world, into what's happening on the geopolitical front, particularly the speed at which these things are happening at the moment, their knowledge of what's going on is as good or as bad as anybody else's. And many of these investment houses don't employ, and they've never needed to employ, so that's the reason why, anyone with any kind of geopolitical background either. We hope at IFI Global, through our weekly, I've already mentioned, to be covering the kind of things that will impact markets from a geopolitical point of view in quite a lot of detail. So obviously the driver of the chaos in the markets of the last few weeks has been the probable impending tariff war. What I would quickly like to say about that, which you perhaps haven't considered at the moment, is that the last time there really was a global tariff war on potentially the level that we are going, I say potentially because it may well all calm down and we may well get back into a more benign period in markets, or the markets may get used to whatever is decided in the next few weeks or months, and we may potentially carry on, roughly speaking, as we were before Trump returned to the White House in January. That's one possibility. The other possibility is that we are in the early stages, only in the skirmishes of a global tariff war. The last time the US imposed tariffs of this size that they're talking about upon their major trading partners was when Smoot-Hawley Act came in 1930. That ended up with the US international trade over the next several years dropping by 60%. And historians, pretty much all historians, put it down as one of the major causes of the Second World War. So those are two extremes of what might happen over the coming months. One would be it all calms down, everyone's relaxed, we get back to where we were. It's all been a bit of a bad dream and life carries on as normal. The other is this is the 21st century equivalent of Smoot-Hawley. And by the way, Smoot-Hawley was very much first targeted at the Canadians and as opposed to the Europeans, but the Germans were really badly affected by it. And then we got the rise of the Nazi Party in the 1930s. So those are the two extremes. Probably it's somewhere in between those two. We will find out in the due course of time. But to repeat, we will be covering this both in our podcasts and webcasts in this type of environment, but also in very considerable detail every week in the IFI Global Macro Weekly. The other thing I quickly want to talk about, and I'm conscious of the time, we've got a lot of stuff to get into, is the second thing on the screen here is the Mara Lago Accord. I personally hadn't heard about the Mara Lago Accord till, roughly speaking, about a month ago. It's in prominence in the international or the financial media, financial press, has gone up exponentially in the last few weeks. For those of you who are not that familiar with it, let me quickly tell you what it is. Again, this is a subject we'll be getting into in a lot more detail. It's the brainchild of Stephen Mirren, who is Trump's head of Council of Economic Advisors. It's obviously got the blessing in terms of his comments of Scott Bessent, the Treasury Secretary. The aim is to weaken the dollar to tackle the US trade and debt deficits. The principle of it is based upon the Plaza Accord of 1985, when the US's major trading partners at the time came together in a coordinated way to lower the value of the dollar. The idea of doing this is that they think it will help reduce their US trade deficit, as I say, also for various reasons, which I'll half touch upon, affect and improve or diminish the debt deficit that with the $36 trillion debt deficit the Americans have. The problem is that back in 1985, when the Plaza Accord came into being, it was very much a time when America had a lot of goodwill in the world. That isn't necessarily the case today. That's one particular problem. And the second problem is with tariffs going on at the same time, becomes a lot more complicated. So the Americans are aware of that. The carrot of getting their trading partners to sign up to it would be to offer relief from those tariffs and also to provide security guarantees, which in effect is what NATO has been, but probably isn't anymore. So if you trust the US, that you can get your traditional NATO security guarantee, and then you get free trade with the Americans if you enter into what they want on the Mara Lago Accord. The stick of this particular enterprise is that there would be a user fee imposed upon foreign holders of US treasuries, probably something like 1% on interest remittances. That would also happen. So it will become, not particularly economically advantageous to hold US securities if you're an international entity. And even more controversial than that is the plan to swap treasuries for what are called zero coupon century bonds. And if they did that, and it's still an enormous big if, but if they did do that, that would technically be the US Treasury defaulting on its international obligations. It would be quite an incredible thing, one of the biggest, if not the biggest, economic event of my lifetime, if that was to happen. And that has potentially untold consequences for markets in all sorts of ways, which we're not even going to begin to get into right now. But let's leave that hanging out there and say we will be coming back and discussing all these things in the foreseeable future. Let's just see what happens with the Mar-a-Lago Accord. Quickly, before I hand over to my colleagues, one of the obvious potential dangers of it, there's plenty of others as well, is it will threaten the US dollar's status as the world's reserve currency. It's been on the way down for a long time anyway, for 10, 15 years. This could potentially hasten it. And it would also likely push up bond yields because it would almost certainly scare off international investors into the US of different shapes and sizes. So that's all I want to say by way of introduction. And I'm now going to hand over to Miguel. Please take it on from there, Miguel.
Thanks so much, Simon. And thanks again for having us on. It's a big pleasure. So firstly, a few things to kind of add to your commentary. The first thing, I guess, is the elephant in the room with regards to rates. Last week, we saw the big decision coming in from the Fed and the Bank of England. They both decided to keep rates as they were, which is good. But then moving on to, I guess, Europe, broadly speaking,
Hello, have you frozen?
We've seen a report from Aviva. Hello, can you guys hear me?
Yeah, I can hear you now. I think you froze for a second, Miguel.
Apologies for that. I was just commenting about the European scenario. We were reading a report about Aviva was writing that report around German bond yields. And they were saying that the 10-year bond yield could reach 4% in the foreseeable, especially after kind of the expected fiscal package in Germany. And that could have an impact not only in Germany, particularly in mortgages and the real estate market, which is kind of experiencing drawdowns already in Germany, but also in neighboring countries. So other areas in Europe, such as Italy, France, and even Spain, where yields could go off the roof completely. And obviously that could have an impact on their ability to face debt service and so on. So that's an interesting point I read from my perspective. The other kind of elephant in the room, as you were briefly pointing out, I think, Simon, from your end, is geopolitics. So obviously we've got continued tension both in the Middle East and in Eastern Europe. But as you mentioned, you've got some tension as well arising from the tariff and the trade situation as well in the US. You've seen Mark Carney as well from Canada referring to the US. I guess that's a new, at least from my perspective. I know I'm young, but it's the first time I've seen it in the past, where the Canada Prime Minister has referred to the US as a potential enemy rather than a friend. So that's worrying as well and it's notable as well from my perspective. Also, just to add to the discussion, I know we've touched upon the whole ESG story in the past. It's very interesting from my perspective. We've seen a Bloomberg article as well, talking about roughly I think it's 5,000 so-called ESG funds having holdings in fossil fuel companies as well, in an environment which is already very skeptical around ESG and greenwashing and all these topics. So I think that's something that's having an effect as well in allocations and will be a theme going forward. And just two main topics as well before I hand it over to yourself again, Simon and Lawin. The one thing we kind of seen this month as well is the S&P 500 drawdowns. So I think it's around 2.4 trillion market cap, which the S&P, the index, has lost this month. And the question that we asked ourselves, and we've seen others kind of answer, is where has this money gone to? So we've seen, some of the money going into other equity markets, in particular Europe, whereas, many asset managers see value in. Also China, but we've also seen it doesn't really account for all the money that's been kind of lost in the S&P 500 this month. And we've seen some movements towards other asset classes, towards maybe fixed income, commodities, and so on. So again, that's something that kind of shows a bit the market sentiment and the uncertainty, particularly around business in the US and tariffs and trade and so on, which is having an effect on equity markets. And maybe we're starting to see what we call as, flight to quality, where, allocators start moving away from seemingly riskier assets as the equity markets, might be a symbol of, towards other perhaps safer asset classes. And then just to close it from my perspective, reliable sources also indicate that there's been some diversification as well from central banks, from in terms of the foreign exchange reserves, in the past being mostly in terms of proportions and percentage amounts. There's been normally, in the past, they were very much concentrated in the US dollar reserves. They've been seemingly moving away from the US dollar towards gold, which I think is also something which kind of shows quite nicely what the sentiments just broadly towards the US dollar and the US and America might be going forward.
Okay, thank you. So, Lawin, this is your chance, I think, to come in and give us, given that global scenario, Lawin, I think you're going to be talking about how LPs that you track from different parts of the world, what they're doing with their portfolios, given the situation that we find ourselves in today.
Absolutely. I think Miguel was mentioning a lot of factors which we have seen in the past where investment momentum has shifted. Geopolitics is one big topic here, but it's also connected to that the private markets feel uncertain, and that's why they want to invest into gold. That's why they want to diversify even more. What I've done is I've selected 5 different family offices we are working with out of the 5 different continents, and maybe I can give you some background information of those family offices, and we can analyze where they have invested, where they are currently investing, and where they might invest in the future, considering all these uncertainties we see at the moment in the market. And again, geopolitics and what's actually happening in the liquid market. Let me start with a European family office. It's basically an Italian single family office. The single family office was set up off the back of the sale of a renewables company to a prominent bank and asset manager. Their assets under management is in the range of 3 billion pounds. They're looking to allocate to hedge funds, commodities through future contracts, opportunistic private credit in the US and Europe. Within the private credit space, they are also interested in senior debt and mezzanine. They are also interested in private equity and venture capital. The minimum requirements for managers is a 3-year track record and at least $150 million in assets under management. Going over the pond to America, this profile is from a US multifamily office. They are based in Texas. They invest across the following asset class and verticals: so private debt, net asset value loans, portfolio lending, private corporate lending, energy, GP stakes, venture capital, secondaries, and private equity. So direct investment into sports team were a big theme for them. And this basically reflects a classic American higher risk appetite as well. let's speak about another big continent, Asia. I selected the Middle Eastern family office. It's a Dubai-based single family office of the founders and majority shareholders of a conglomerate group. Exists with the purpose of diversifying the group's holding to other areas. They invest into real estate in the US in particular, private debt, venture capital strategies as well. Now let's go to Australia. So I'm speaking about the Australian single family office, which was created out of a liquidity event. The founders' business was in real estate. That company was sold, and now they invest mostly in, again, real estate, typically in equity positions. However, during the last couple of years, the focus has drifted towards real estate lending again. And finally, Africa. So I would like to speak about the South African family office. This South African family office is catering to select group of individuals and families. They invest in the following asset classes: private equity, venture capital, private debt, direct property, hedge funds, cryptocurrencies, and commodities. Yeah, so these are the different family offices we have. One tendency which basically comes out of the market is the movement towards recurring dividends in terms of loans, lending, debt products. But on the same time, when we speak about Miguel's comment of the S&P 500 is losing a lot of investments, and that's being diversified, we always need to consider what is always happening. The public market starts because they're liquid and they're much faster than the private market. We are at a risk where the private market might follow on to the public market. This means not only will money be taken out of the S&P 500 and US public companies, because that can be done really, really fast. That can also happen with investments in the private investment market, where those family offices are saying, you know what, it's too much uncertainty in the States. We don't want to be overexposed to the US market. We want to diversify back into our own continent, or we might want to go into Asia, which is a big topic as well. Keep in mind, I mean, you, Simon, you mentioned the history. I would say what I understood was that the European countries were always friends with the States, and whatever the states, whatever the politicians, the states decided, the Europeans were following. With China and India now being also powers in geopolitics, they are not necessarily friends, they are more neutral, and they want to make business for themselves. And if it means that they have to go through the US, they will. But if it means that they do not need to go through the US, they will also do this for the benefit of their own citizens. So we have to be very, very careful. So what does it mean for the GPs who are listening today? They probably have to invest more into marketing to attract capital towards their funds and their investment opportunities. And it might not be as easy as it was, because a lot of capital might go into India, a lot of capital might go into China, and a lot of capital might just remain within their own continent.
Yeah. We're at the state, we don't know, as I said in my short little piece, whether this is just a brief hiatus and we will be back into quote unquote normal trading market environment by when? I don't know, the second half of the year, by the beginning of the autumn, whatever, pick your preferred time, or whether this is a sea change from the reasons that Lawin has just given and that Miguel gave. We're talking potentially about a readjustment of the global economy in a way that, you know, no one was even talking about, you know, before January the 20th, because we just thought Trump 2 would be like Trump 1. Trump 1 was basically, whether you like Trump or dislike Trump, it didn't really make a big difference to the global economy, particularly but we are talking about all these things that are happening, for better or worse, and they're certainly talking about them. How much of it will really be implemented? And to Lawin's point about, the reorientation of the global economy with the Indians and the Chinese, etc. And one of the things that people should bear in mind is majority of Chinese trade is now done in renminbi. It's not done in US dollars. That is quite new. And it's not likely to go back, given all the craziness in the current, I was going to say in Washington, maybe that's getting a bit pejorative, but given the lack of stability and the lack of certainty about where things are going, that we're going to get back into that. But Lawin, let me ask you a question. One of the scary things you just said is that if there could be a follow-on from what's been going on in public markets into private markets, do you really think the investors in some of the sort of very liquid alternative private strategies, are going to be affected by what we've been talking about today in terms of reducing their allocations?
I think there's certainly a huge risk. If you think about 20 years ago, what were your options? US, Europe, and Japan, not even Asia. Right now, you have a lot of different options. You can trade with apps on your phone. You have more exposure. The world is more global, and also the investment opportunities are more global. American GPs who are investing into, let's say, multifamily houses in the Sun Belt are facing competition, not only from New Yorkers or Californians. They're facing competition directly out of China and India and Japan and Europe. In the past, it was only US and Europe. And if the political leaders are not showing that they can create stability within a region, then I don't want to invest into a risky investment opportunity. I might go somewhere else where I'm getting a much higher return, and that's reflecting the risk and the Sharpe ratio. But at the moment, I see there is a huge risk, and we need to be very, very careful. It doesn't mean that everybody's going away from one day to another from the States, but it means that what was easy to achieve in terms of raising capital for Americans in the past became way more difficult because what has happened in the politics and also the rise of other nations.
Just to add, I guess, from my end, Simon, as well. So I think you pointed out what we are seeing with the S&P 500, particularly this last month, might be, as you mentioned, a sea change, something indicative of maybe changed preferences of investors, maybe going into or exploring at least other geographies, or it might be merely a correction. So we've seen, the multiples the S&P 500 has commanded, especially some of the companies within the S&P 500. So what we might be seeing is merely a price correction, which will, doesn't mean too much. It's just the correction. Or as you mentioned, it's a sea change that indicates, what's going to come, which is maybe greater interest or just movements away from the US, generally speaking.
Yeah, what I was going to say is that picking up on that point, but also on what Lawin was saying, is that we're in a situation. I mean, and by the way, it'll be next month again. We'll do the quarterly allocation update, and one of the things that I haven't got the figures in my head, but so much of the flows. I mean, US has been by a country mile the most popular place in the world for everyone to invest over the last few years. Including in private markets, from the kind of people you've been, the family offices, etc., you're talking about, citing from the different parts of the world. It's probably too early to ask you this question, but are you picking up, or in terms of what you see with all those LPs you track, are you picking up any changes in patterns because of what's been going on in the last month or two?
Not yet. The interesting part is really that the public markets are leading and the private markets are usually following. What we are picking up is the trend to, again, more safer investment opportunities. We have seen this in the public market with investing into commodities. If there are huge problems, then everybody invests into something which is tangible, which are commodities, which is gold. Then also the next more secure asset class is fixed income. This is a trend that we have seen, what we have discussed with family offices on a day-to-day basis. We have not yet seen the trend of moving away from the US. However, what we have seen as well, and that is not necessarily related to the geopolitical uncertainty, it's more the rise of the two Asian nations, China and India, of their great performance in terms of, let's say in India, it's a tech environment, and in China, it's the industrial environment. Family offices have asked whether we see any GPs and asset managers who are offering these investment opportunities, and whether we can help them to find the unique and special investment opportunity. It has been difficult in terms of administrative reasons. Those two nations are trying to make it easier for investors to invest into their country, but on the same time to pull it out. That was a huge advantage for the US. You just need to set up an SPV in Delaware or Cayman Island, and you can place the money, you can take it out. It's very, very easy to invest into the US. But as soon as these two nations are doing this and they're delivering even higher returns with an exceptional track record, then there's a lot of money which can be raised for China and India.
Yeah, and in terms of the LPs you track in the US, again, it's probably too early to ask you this question, but I will ask you as a sort of marker to put down for the future. Do you see any greater level of diversification outside the US into those markets you've just been talking about, for example, China or India, or indeed good old Europe, or whatever it may be? Are there, would you foresee, or there is going to be more US LP allocation internationally because of the lack of stability in the US?
Well, there is a hype for sure about Asian countries and other emerging markets. What we have seen is really depending on the individual investor and the individual family offices. Some have invested in India, for example. Some have invested obviously also in China. Some have been burned. Some have been very successful. So need to be very, very careful of generalizing here. But yeah, there is interest. So let's call it like this. There was no interest 50 years ago. Now there's interest. Okay. Now that's basically again showing that there is more competition globally for US American GPs and obviously European GPs.
I would say as well, Simon, that we're seeing that not just from an LP perspective, but from a GP perspective as well. So we've seen prominent GPs set up shops in, say, for instance, private equity managers setting up in or investing heavily in Japan, for example, where there's opportunities in private equity, or in India, where there's opportunities again in private equity, private debts, or even in some parts of Europe, where there's a lot of concentration of family-owned entities and a lot of efficiencies that can be driven by investing in those companies. So we see that both from an LP perspective and from a GP perspective too.
But keep in mind as well, Americans are very centered around America. It's a great country. It's a big country. It's delivering a lot of returns. So why should someone think about going outside of the States? As soon as you start to understand the global investment landscape, then you are starting to consider also other countries.
Yeah. Samantha, I think we've got two questions in. So
Yes.
shall we tackle them? And do you want to read them out, or read the first one out?
So the first question is, what is the projected timing of the Mara Lago Accord?
Yes, I don't think anyone quite knows. I will take a stab at it. No, there isn't. It's none of this is absolutely definite. This is all Scott Percent or more Stephen Mirren. There's definitely something coming because Scott Percent has said, I think he even just said again something last week that there's going to be a realignment of the global economies coming. They are really on a radical path. This, in case anyone didn't think this, the new administration in Washington, D.C., and they are coming for the global economy next. As for the timing, we don't know exactly what's coming, and perhaps Trump doesn't know himself. Maybe nobody does. Something is going to come because they are very intent upon trying to tackle the public debt levels in the US and the enormous trade deficit the US has as well. I would guess they'll wait until after April is going to be a huge month on the tariffs. The beginning of April, I think April the 2nd, the administration is announcing its next round of tariffs. By the end of the month of April, we should know what the retaliation to those tariffs will be. Some countries have been holding back so far. We will get a much better idea by the end of the month. It's kind of bad timing in some respects for those of us who want calmer, more peaceful times, that there is now a Canadian general election going on during the month of April, because I can see the rhetoric getting very fever pitch as that election progresses. And I don't think anyone in Canada is going to want to make concessions if they want to get elected. My daughter is currently living in Montreal at the moment, and believe me, Americans are not popular in Canada at the moment. I can tell you that for nothing. So we could be in the situation by the end of the month of April where we know where the tariffs are, then the Mara Lago Accord, then this stick and carrot thing I talked about in my little piece could be waved in front of people maybe during the summer months. But I think this won't happen overnight. It'll probably drag on over the second half of the year. But it will be potentially, it will be destabilizing in markets. Markets do not like instability. They don't like waking up in the morning and not knowing what's going to happen. And if, as I said, which is a huge if, the US Treasuries are going, the traditional US Treasuries are going to be swapped for these so-called century bonds, that is technically a default. And God knows where that, I mean, it's always the law of unintended consequences. It's the things you can't foresee that could be coming. That is very worrying. So that's my answer to question one. I see another question has come in. What was the second question?
May I add?
Yeah.
May I add something to that, Simon?
Yeah, go ahead.
I think I was always bullish towards America. We should consider the timing as well. I think now everything is a little bit down globally and also in the States. I would still invest in the States personally, and I would also recommend because at times of uncertainties, new groups, new emerging managers might come up with better operations, who are not satisfied with the large asset management company, and then they just deliver much better operations. So we should focus on those emerging managers as well.
Yeah. Since we've only got 5 minutes left, Samantha, do you want to read out question 2 and 3 and give it to Lawin? I think the third one is directly at Lawin, and the second one would be best answered by Miguel or Lawin anyway.
Right. So the second question is, what are the safest private investment strategies to be in at a time of intense public market volatility?
And do you want to read
Miguel, let's agree to disagree, and you have a different opinion than I have.
I am dying to answer this one, Samantha. Thanks so much for posing that question, or whoever asked the question on the chat. Yeah, so traditionally one thinks of debt as the safest asset class, I guess, to invest in, also within private markets. So obviously there's nothing that's 100% safe, but I would say that, you know, if you invest in debt securities in a high quality asset that's kind of well funded and it's got enough equity, that's got stable earnings or income, and that's, you know, the funding is stable on that front. I think that's somewhere, and I think this, we're seeing such a big movement towards private debt, not just because interest rates have gone up, which makes return higher, but also because there is that kind of flight to quality, if you like, going on as well, where investors are recognizing that, there's greater uncertainty and greater risk, and that private debt might be a safe haven from that perspective.
Yeah, I think the question is about the keyword safe. What is really safe at the moment? Safe is something, in my opinion, where there's strong operations behind that, where there's a track record, where the operator and the general partner has delivered over the last 20 years some good returns, and it can be everything. However, what you just mentioned, Miguel, a lot of people are trying to go into debt because the interest rates seem to be still high in comparison to the negative interest rate environment we had in the past. That's why a lot of the LPs want to lock that interest rate right now and receive those returns. Not necessarily the best returns, in my opinion, but this is what you can do right now. In my opinion, this is going to shift again in the next, let's say, 18 months. But yeah, if you have a really good track record in a certain asset class, and then it doesn't really matter whether you are investing into a new development property where construction, which is usually considered opportunistic and risky, but if you have done this 99 times, and you won't most probably fold if you are doing a new construction the 100th time, right? You have done it, you have the experience, you will do it again. In my opinion, you should just focus as an LP on the asset classes where you have invested in the past, where you have a very good due diligence. Make sure you're doing an incredibly good due diligence and not just toss money away because some of your friends, some of the other family office said, oh yeah, we have this great investment opportunity. Just don't be lazy, right? At that point where you have a very good due diligence team in house, you might make a good choice.
Right, we got 2 minutes left, and you got one question that's very much aimed at Lawin. So do you want to read it out, Samantha?
So hey Lawin, as an Indian GP at an early stage sector agnostic VC fund, do you believe it's a good time to be pitching to international family offices, given all the discussion regarding the present interest in Asian economies you've mentioned?
Of course, you're answering the question yourself. Let me give you two stories. So there was this one LP from California. They have been they have been Americans, and they have invested into India, and they have received really good returns. In contrary, there was another LP with Indian heritage or Indian roots who have also invested into India, and they have been burned. So you need to understand these things as well, that there have been already GPs who were promising a lot of things to LPs globally, and some of them have delivered, some of them have not delivered. Make sure that you do your first due diligence in-house, that you can offer your investment opportunity, and then go out to the market. But you should always try to diversify your investor pool, because if there is some uncertainties in the world, and let's say you are from India, you only have Indian LPs, and suddenly there's a huge problem in India, a lot of the LPs might want to pull out the capital and invest somewhere else. If you have a more diversified investor pool, let's say you have Indian LPs, you have Japanese LPs, you have American LPs and European LPs, and there's a problem again in India, your non-Indian LPs might stay within your investment opportunity, and you're not losing immediately liquidity problems, or you don't have liquidity problems.
Well, thank you. I think that's probably a very good note to end on. Thank you all, those of you who've been following us today from the various different countries around the world. I see India as well as various other countries in Europe and the States. And as we said at the beginning, we are putting this into our podcast and libraries. Also, you can see the video of it in another part of our website as well. And we'll be promoting that very heavily in the next few weeks. And all of this stuff is covered in tremendous detail in alternative investment strategies. And the weekly, as I say, goes with that. So if that's what is of interest to you, then we strongly recommend you subscribe to those publications, and hopefully see you on the next one. I see another question is coming in at the very end. I don't know whether you want to, we should probably, oh, thank you. Yes, somebody just saying thank you from Mumbai, because it's 10:30 at night in Mumbai. So thank you for staying up so late for our particular discussion today. And we'll have to do some earlier in the day for the Asian markets, Lawin and Miguel, in the future.
Well, I'll be back in London next week, so then we can think about different timing. Right. By the way, next week we're speaking about venture capital, an interesting topic, something which affects me a lot. We have some guest speakers as well, who are coming from Silicon Valley and who are also coming from Europe. We're going to have some different views on that.
Fantastic. That is actually that's in 2 weeks. That's on Monday the 7th of April.
7th of April, correct.
Fantastic. Well, goodbye, everyone. Thank you for joining us. Have a good morning, afternoon, or evening, no matter where you are in the world, and see you the next time. Bye-bye, everybody.
Thank you.
Thank
Bye-bye.
you so much. Cheers, guys.